5 frequently asked financial analyst interview questions. Hey guys, welcome to another video. My name is Bill Hanna and this is the Financial Controller channel where we talk about tips and tricks for accounting and finance career based on my own knowledge and being in the game for the last 15 years. I've been a licensed CPA in the great state of New York for the last 5 years, and I've been a hiring manager, and I've also been a job seeker, and I know from both sides of the table the most frequently asked questions in terms of accounting or finance career. Before diving into today's video, I just wanted to give a big thank you and a shout out to everybody who subscribed to the channel. This is a young channel. We only started out a few months ago and we are now at about 800 subscribers. So thank you so much for that. It's been a huge support and it encourages me to do more and give you more in the next videos. So in today's video, we'll go over the 5 most frequently asked financial analyst questions. We'll go over the questions and their answers, and then at the end of the video, I'm going to give you what I think is the way that you should handle these questions if you don't know the answer. So if you have a deer in the headlight moment and you're asked a question, you don't know the answer, how did I see as a hiring manager will be an acceptable behavior, or what should you say in this kind of situation? So without further ado, let's dive right in. Okay guys, so the first question goes like, what is a key ratio to consider when evaluating a new business? Now, the reason why I put this question at the beginning of the video is because this is the most frequently asked question. It comes up a lot in interview questions for financial analysts. And so the best answer, in my opinion, is ROI, which is return on investment. And the way that you can explain this to the hiring manager is ROI is a return on investment calculated by taking net return, dividing it by the initial investment. And the example here that I want to share with you is that if you are buying an Uber car, let's say you want to buy an Uber car and put it to work for you and hiring a driver so that they can drive it and you can make money from it. The ROI for this kind of business is that you'll take the net return, which is $5,000 in this case, after deducting the wage for the actual driver, deducting all the expenses, the maintenance, the gas, and all that. You'll make annually $5,000. You divide that by the investment or the cost of buying the car, which is $25,000 in this case, and so your ROI is 20%. And this covers our first question. Now for our second question, the question goes, what KPI is most important for measuring profitability? And now I think there's a couple of different acceptable answers here, but I think that the most relevant answer will be gross margin. Gross margin is taking gross profit and dividing it by the amount of revenue. The reason why this is an important KPI for measuring profitability is that you can benchmark. So you can look at 2 companies and evaluate them. One makes a gross margin of 25%, the other one makes a gross margin of 30%. So immediately you can tell which one will be a better investment for you. So gross margin is one of the best or the most looked at KPI when it comes to measuring profitability. And if you're curious to learn more about KPIs, I have a full online course in KPIs. I'm going to leave a link to that down below in the description if you're interested to take a look. And now we're moving on to the third question. Now the third question goes like this. What is EBITDA? And now in most cases in interviews, they'll ask you what is EBITDA and why do we care about it? And the way to answer this question is obviously to give the definition of EBITDA, which is earnings before interest, tax, depreciation, and amortization. Another way EBITDA is referred to sometimes is operating profit. And operating profit means that this is the amount of profit that the company makes before taking into account non-operating items such as interest, tax, depreciation, and amortization. And obviously the reason why companies measure EBITDA is that EBITDA is a way to look at the company's operation and understand how much profit the company makes before going into interest, tax, depreciation, and amortization. Many companies, when they acquire other smaller firms, don't really care about items such as interest, tax, and depreciation and amortization because they think that they're going to fold this operation into their business and they will have a lot of savings and interest and tax and all of these items. And so that's why EBITDA is important, because it looks at the company's profitability before non-operating expenses. And that covers the third question. Now for question number 4, the question goes like this. Where do you see dividends on the income statement? And now this question is sort of tricky because the interviewer is trying to gauge your understanding of the mechanics of the financial statements. Dividends don't typically go on the income statement because dividend payout is not an expense. So the answer is that you don't see it in the income statement. You see it on the shareholders' equity statement because dividends They're not an expense. What they are is a distribution of the company's prior profits. So the company has been accumulating profits throughout the years, and they are now just distributing some of that profit to their shareholders. And so it's a reduction to equity, and it goes in the shareholders' equity statement and not in the income statement. And so this is sort of a tricky question, but remember that dividends are not an expense. They are not an expense. They are a distribution of the equity, or a distribution of the profits that the company has been accumulating. And that is the answer to question number 4. Now for question number 5, the question goes, if accounts receivable keeps going up, what could be the driver? And in this question, the interviewer is trying to gauge your understanding of how accounts receivable works and the dynamics between accounts receivable, cash, and sales. And so if you imagine a situation where accounts receivable keeps going up months over months, what could be the reason be? What could be the driver be? And so the two drivers, in my view, are either a collection problem. So if you're not collecting your accounts receivable on time, obviously the balance of accounts receivable will keep building up. But there is another reason, which is actually a good one, is when you have increased sales or sales growth. So if your company keeps growing its sales, obviously the accounts receivable will also keep growing up in the same direction as sales. And so the way in real life, the way that we mitigate as accountants or financial analysts, the way we mitigate for this kind of problem is that we're always looking at the aging schedule of accounts receivable and making sure that none of the accounts receivable is aging out more than, let's say, 60 or 90 days, so that we are making sure that we are collecting on time. And so like if the collection problem is solved, all we're left with is that increased sales, which is a good thing to have. If our accounts receivable balance keeps going up because of increased sales, that's great. And that's the answer to question number 5. And as I promised you at the beginning of the video, I'm going to tell you what you should be doing if you have a deer in the headlight moment during the interview and you hear one of these questions that you don't know the answer to. The first thing you should be doing is that you should slow down and ask for a pen and paper and just draw it out. This is a sign of maturity, that you're taking your time, you're not rushing into giving just any answer. So the first thing you should do, slow down, ask for pen and paper, and draw it out. Now, after all of this, if you still don't know the answer, what's very acceptable from my view as a hiring manager is that you can tell me something like, I'll follow up with a follow-up email after this interview with the right answer. I don't know the answer right now, but I'll do my research and I'll send you an email after with the right answer. This is totally acceptable from my view as a hiring manager. It's not as good as giving the right answer on the spot, but it's second best, right? The worst thing you can do is rush into giving the wrong answer. And so either slow down and give the right answer, or slow down and say that you'll send a follow-up email with the answer, and just don't rush into answering any of these questions. So that's it for this video, guys. If you liked it and you learned something new, don't forget to give me a thumbs up down below and subscribe to the channel if you haven't done so already. And if you know someone who's going on a job interview soon, please share this video with them. Thank you for watching, and I'll see you in the next video.